Hello, everyone. This is Lyadov, and today I'm not really in the role of a blogger or journalist. I'm here as a businessman because I've been involved in a pretty classic type of business for a couple of years now. But at the same time, yes, I'm going through some stages that I've never encountered before. So basically, everything I'm going to ask today, I'm not asking just out of curiosity, but because I really need it for business. Therefore, a very important moment, probably the key moment, is always the meeting with investors, because at that moment you realize that everything you've done might not be needed by anyone. Or it might be needed. It varies. So today I have some really cool guests in the studio. Vlad Tropko, an investor with a huge amount of experience, over 15 years. Initially, he was a venture investor. Today, he's an investor in SMB companies. And Anton Gladkov, a person who has been involved in B2B sales all his life and is actually a super expert in this field. And today, Anton has his own company, which in general generates the best and probably the most massive leads for B2B as much as possible. I'll start with a speech. So hypothetically, look, Vlad, I come to you and say, Vlad, look, we're offering 18% return on investment for a $1 million investment. Okay. Would you give it? No. Well, look, I have a lot of hats. From time to time, I put on these hats to understand from which perspective I'm looking at a particular project. This struck me at some point because I realized that I go around saying, guys, let's make 50%, 60% profit. No, we're not interested in that. We want something like 5,000%, and that's 50 times, right? 51 times, at least. Well, we're not dealing with drugs. Well, actually, the economy of a venture fund is built on the idea that if you invest at an early stage, when a person only has an idea or MVP, each project should have the potential to return from 100 to 1,000 times, maybe more. Venture is from 100 times, at the early stage. There are later stages of venture where it might be less. The later the stage, the fewer times the investor requires for a return. So, hypothetically, right now a company like SpaceX is trading its shares on the non-public market. So, investors are gathering to buy and sell these shares. And the return requirements are 2, 3, 4 times, probably, just as an example. But 20 years ago, when SpaceX was starting, the requirement from investors was no less than 100 times. Then I put on the hat of the second investor. This is an investor who invests and buys shares in small and medium-sized businesses. So there are hypothetically two approaches to the task. There's the approach where you lend money to people for small and medium-sized businesses. So the classification of a small business is hypothetically profit, as you said, up to 5 million and turnover up to 50 million. For different investors, it's different. It depends on the country. In England, a medium business is somewhere up to 20 to 30 million pounds in revenue. In America, a medium business can easily be up to 500 million. If your business is profitable, we believe you have two options. You can borrow money from a bank, or from friends, or from specialized funds that specialize in lending money to small and medium-sized businesses. Or you can raise money by selling your shares. And then you look, if we're talking about shares, the question arises, from whom can you raise money by selling them shares?
It's not just a monetization direction. It's like you're building your own corporation that invests in small companies. You can't just get by with investments. It doesn't work that way.
What do you mean? Like you need more control over the founders and everything else?
The ecosystem, control over the founders, bringing in various third parties, fulfilling this civic duty of smart money. Of course, it's often poorly executed, but ideally it should be done.
What is the civic duty of smart money?
Well, it's like when you turn to an ecosystem engaged in venture investing. It would be great if, besides money, it also provided some tools that would help you in life. I don't know, from simplified bank account registration to some sales specialists. In an ideal world, people should invest and immediately bring in people like me into the business who will instantly generate leads. That would be a smart money move.
Bringing in leads, bringing in lawyers, accountants, and so on. Bringing in executives. One classic example of smart money was when Yandex spun off their Click, the name escapes me, Click something. I need to remember what it's called. Top investors came in, they brought the entire C-level team, and the first round was valued at over $1 billion. And now this company is worth more than $10 billion. Thanks to minimal monetization, but an excellent product. These guys brought in good executives, good managers who were able to scale the product. And now it's one of the top products on the market.
Uh-huh.
Okay, so my task is to increase revenue or do something else.
No. Look, regarding the pitch, your task is initially to decide what game you're playing, because if it's a venture game, your task is first to understand whether your market size is genuine and not just made up, as in most pitch decks. In other words, roughly speaking, let's say you know that your revenue from one client will be, at best, $10,000 a year, and at worst, for example, $1,000. For some reason, both scenarios suit you because the math is favorable. But the thing is, investors are always interested in how many real customers are on the market, because an inexperienced person who wants to get into startups usually makes the main mistake of thinking, yeah, everyone needs this, and there are millions and millions of them. Although if you conduct a real analysis, there's a chance you have 50,000 customers, of which only 10 are actually reachable. If you calculate it on a calculator, there will never be a 50 times return. Even if everything goes perfectly according to the business plan, there still won't be 50 or even 10 times returned. And in the end, person spends time pitching this for years and eventually says, damn, venture investors are bad. They don't give me money. But he's just bringing them something they don't need at all. It's not enough to have, for example, a product that sounds amazing. It doubles someone's sales. That's not enough to build a business because there's a chance it's still not needed at all.
And something more specific between them.
Well, we're going to the market, for example, offering something that, if implemented, someone made it. For example, some entrepreneur, if implemented, some metric doubles. And this metric looks great on a calculator. So it's silly not to install it and use it. But you go to 100 companies, talk to 100 top managers, and it turns out they have other problems, tasks, and desires that your thing doesn't fit into at all.
Like, did you solve a non-existent problem or a not very important problem?
Yes, not very important, because some people, they think, especially if we're talking about someone who's just started raising money, for example, in a startup, they aren't very familiar with the world of big money. They just think, well, like, money is better than not having it. But in the world of big money, everything is a bit different. Everything is a bit more complicated. That is, for example, let's say we can now integrate something and earn an upside of $3 million with some amount of operations needed for, or by applying less operations and focusing your attention elsewhere, you can earn $100 million. What would you choose? And there's a chance that, for example, your solution, even though it makes sense, it makes too little sense for there to be a high conversion. And consequently, the coolest players in the market are already unavailable. Even though we sold them to investors, we sold investors on the fact that our market volume includes these, IBM and Oracle. And then, when it turns out what's really happening with sales, it turns out we're selling at best to semi-crippled SMBs. And there, our market is not 200 billion, but has become 2 billion. And everything starts to fall apart like a house of cards. And investors, they're experienced guys. They know this can happen. And therefore, before they get into a relationship with you, because you have cool technology that they verified, they first want to see how necessary it is. Prove to us that it's really being bought.
If we're talking about the VC market, the most important thing in the VC market is outliers, those who take off almost without paid traffic. That's the concept. Some myths of ancient Greece. Well, sorry, but if you look at some of the projects that are now earning hundreds of millions of dollars, pounds, and so on, you'll see that some of them started, from scratch and took off. Then, when they took off, they got money. Often investors came who saw that the whole story was taking off, rushed in, knocked on the door, and gave money for even faster growth. That's roughly speaking, but there are a huge number. In the App Store, there are dozens of apps that earn their millions of dollars without huge investments in marketing. If we're talking about B2C products, most often, 5 to 7 million in annual revenue is the target for you to be noticed, especially now. 5 million in revenue? Yes. So that's to be noticed in the industry?
Yes, yes, yes.
It's just that now it's so... Well, it's considered that now it's so easy to build a product that will earn 2, 3, 4 million. Again, that's the industry's opinion.
Wait, but that's not very fair to me, because there's no point in doing something very cheap in IT unless you either have access to some very cheap or very understandable money that will let you suffer and buy traffic, or if I don't even know what the second thing is. Basically, you need to have a check. That's quite high. I don't remember when there were times when something was cheap. A click, for example, or one lead. So now just in a mobile app where some guy is just collecting some cubes, one paid user easily costs $80. Yes, that's the reality. And it's not a fact that it will pay off, meaning you have to buy a lot for them to somehow break even on average. In B2B, for example, I very often see leads for $1,000. I very often see leads for $2,000. There are markets where it averaged $5,000 a year to get leads with a 10% conversion rate, and everyone claps their hands. That's considered very good. Well, because they have a high check, meaning a high check is needed. And if the check is high, then actually, I think many people talk about startups. Don't pick up a calculator. So, if you have one client who, let's say, pays you $10,000 a month, then he brings you $120,000 a year. It's like 8 such clients make $1 million. So, roughly, how many clients do you need to get $5 million? So, in principle, if the founder can't handle such a task, then who might be interested in giving him money? Of course.
So undoubtedly there are, well, again, in different categories, different requirements. Yes, for startups, yes. So conditionally, if we are talking about SMB startups that focus on SMB, those same 5 million can be easy because you have to show that you can sell easily on a mass scale, right? If we are talking about enterprise stories, where there are long sales cycles, where you have a person with $1 million, 2, 3, maybe an LOI with a large client is enough to confirm that you can sell and that you have a product that people need. Well, in principle, if you made 5 million a year on your startup, in principle, you can already talk about it, I don't know, on LinkedIn.
You need to talk about it if you've just come up with a startup and haven't written a single line of code yet. So that's the main problem, I think, with teams too. Like, there's nothing cooler than free traffic. But as we found out in the conversation before, it's quite difficult to get free traffic. But there's one way. You need to do PR.
Talk about it.
You need to do PR and say the same thing over and over. Just PR is a kind of all-encompassing mix of talking about yourself and what you do.
It's very interesting because I think for a Russian-speaking businessman in general, since in Russia, it's not very common. It's like, if you did such a cool project, it will sell itself, When Oleg Tinkov came and started showing his Tinkoff bank from every iron, everyone was like, why is he so bold? It's not customary for us to do so much. And he learned this at Berkeley, so to speak, and said that you need to go and show the product at every corner. And it's like, there's really such a difference that here, well, I agree. Do you agree that you need to talk about it right away? Look, I absolutely agree with that. It's not just a Russian problem. It's a global problem. In principle, they teach this in universities in the States, right? And only in the top ones, right? In universities. Simpler ones. They don't teach this. And they don't teach this in England. It's, in principle, a very rare gift. People are taught to be entrepreneurs.
But sales are not taught anywhere, which is also an interesting aspect. No matter which institute you go to, anywhere in the world, they don't teach sales. They teach anything else, but not sales. You can only learn them on your own.
Really?
Yes.
It's like...
Yes, they can teach you how to speak. They can, I don't know, tell you about psychology. They can explain economics to you. All of this is important in sales, but specifically, what you need to do when you're not the only one in the room, and how to capture attention, negotiate, ensure everything goes smoothly, and have the right outcomes. Only the person themselves can do that. It's not taught anywhere.
No, maybe they do teach it somewhere, but still,
but you have to be somewhat gifted.
You have to learn, and through practice, you'll greatly improve your skills.
To sum up, there are only two stages in sales. Not yet sold, already sold. This is a very useful perspective on sales. Because when, for example, startups or people joining a corporation see these pipelines drawn by some, well, pretentious lecturers who actually usually can't sell anything themselves. Because if they could sell, they wouldn't be lecturing, since you earn much less from lectures. They usually like to invent a billion different stages, and everyone thinks about how they moved from one stage to another. But it's super harmful when people go through the first steps, and even the first 1,000 steps in sales, because they experience dopamine where they haven't earned it yet.
Salespeople,
if they have the opportunity, when they report to their higher-ups or their colleagues, partners, investors, they say, like, we've already started 150 conversations. We've already met with 15 people. We've already, but there's no money. And the thing is, you can always come up with a way to turn your useless actions into a beautiful report. Oh, yes. I've encountered this, yes. But in sales, the thing is, you really have the right to report when you've brought in money. Otherwise, it's just a fairy tale about a spinning wheel.
all right, great. The formula consists of two: not yet sold, sold. Here are the stages of your interaction. Can you try to specify them, name them? Like there's a person in front of you. What do you need to do for them to buy from you? 3 or how many? 2 points? 1?
Well, look, first of all, you shouldn't sell. Yes, the worst situation is when a person sits and directly sells. They're sitting in the seller's mask, in the seller's chair, and trying their hardest to squeeze out the next 5 minutes of activity, which must be related to some iteration of sales within this conversation. But that's like loser thinking, very novice-like. And basically, well, what is a sale? It's a connection between two entities where there will be a mutual exchange of some benefits. So, first of all, you need to understand your side very well. The product aspect, the economic aspect, the historical aspect. In short, comprehensively understand what you're talking about with people. Be an expert in it. For example, when I worked with Kostya Kalinov at Aviasales, the first thing he started with, and he was my mentor then, and I'm very grateful to him for opening my eyes to this. He told me where airplanes came from, starting with Zeppelin airships. So, like, until he told me the whole story of the airline market, we didn't move on to questions about what Aviasales is and why it's needed as a meta search engine that sells tickets. Accordingly, when I went to talk to someone from Aviasales for the first time in my life, I was a professor of aviation. Naturally, this clearly didn't hinder my ability to sell. Next, let's say you've studied all this. You've absorbed everything. You kind of understand your industry. Now, the question is, what do you understand about the industry of the guy sitting in front of you? Because many people, for example, talk to an investor, but they have no idea how he makes money. They have no idea what he's worried about, which numbers are important to him, which aren't, what numbers mean to him, and so on. And accordingly, it turns out that all they can do is just tell their version of events.
As a founder, out of 100% of what you can do, how much should be selling? 90% of our lives is sales. You, as a founder, sell yourself to investors. You, as a founder, sell yourself to employees because you have to lead them as a leader into the distant future, and top people should follow you. You, as a partner, sell yourself to your wife or husband during dating, and so on. You
even sell yourself to your mom and dad.
You sell yourself to your mom and dad? Absolutely. As a good son or daughter? Yes. Absolutely. That is that is kids, the same thing.
Even to yourself. Damn, I just thought.
Well, of course.
You can actually avoid falling into depression if you sell yourself well, right?
Cool, yeah. You thought about it, like, remember not the bad things, but the good ones, and you're already satisfied? Yes, absolutely. That is conditionally. Therefore, if you ask me, should a founder be a good salesperson? Yes. But then the question arises, will he sell 100% of the time to clients, sell to employees, sell to investors? That's another question. That is, among some. Elon Musk is a great salesperson. Sam Altman is a great salesperson. Why is Elon Musk a great salesperson? What factors lead you to that conclusion? By results.
That is, not only by results, actually, the full package. That is, like, how does he perform? How does he perform?
What do you mean?
Well, listen, I can't tear myself away, given that I'm a person of words, absolute and proven by all metrics. But when I watch Elon Musk perform, it hypnotizes me. That is, I watch his interviews. If it lasts 2 hours, I can watch for 2 hours. This is actually not a very simple skill.
I read that you're a rare investor who invests in immigrant founders. Yes. Do you still consider this an important factor in what a founder represents in general? My view on immigrants is that they are people who take risks. That is, they have already detached from their roots and have taken a big risk by moving to another country, learning a new language, a new culture, and so on. There's a concept of how much time should pass after moving. Because, as even my experience of moving to England shows, it takes about 1 to 3 years to adapt. To get your kids into school and to settle your own life. It just takes time. And while you're settling in, it's very difficult to start a new business. You simply don't have the time or mental capacity for it. But once you've done that, on one hand. On the other hand, while you're adapting to the local reality, you meet people. You know where to hire, where to recruit people, where to raise money. And all this takes some time. But once you've done that, you see, if you look at any big city, the people there, 80 to 90 to 95% of the people who were born and raised in a big city are much less ambitious compared to those who move to these big cities. Well, I agree, as statistics show. And accordingly, because they are ambitious, they can and want to achieve more. We were just discussing with some investors a while ago that the biggest risk for a venture investor is not that the project will fail, but that the founder will be satisfied with their salary. Interesting.
I think it still won't work, because if a person is such that if you give them a little more money and they start to be satisfied and stop developing the company, they still won't build a big company.
That's exactly the point. The essence is that, roughly speaking, during the pitch, people all say how they believe they'll become billionaires. But real life shows that, and I have cases where founders reach a level of $1, $2, $3, $4 million in revenue, and they start paying themselves $50, $100, $70, $200,000 a year. Some reasonable figure. They don't need more, in principle. I don't know how you didn't relax at 25 with your Avia sales, I don't know. Because something else has to happen to really drive you.
Listen, by the way, I have an interesting story on this topic because there's a specific answer to how it happened. Like my grandfather got cancer, and it was in Novosibirsk, and I was in Thailand with Aviasales. And I had a top manager salary of $10,000, which is absolutely unthinkable for someone from Novosibirsk my age. So I was like an absolute mega superstar. Yeah. And I kind of thought so myself, naturally, because I was 25. And I eventually flew to visit him in Novosibirsk. And I go into the hospital, and I literally start crying when I look around. I just see this terrible hospital, the terrible building, all the urine stains on the walls, And I'm like thinking, oh my God. I went up to my mom and said, Mom, why are you doing this? I mean, I love Grandpa. I made it. Why didn't you let me pay? And my mom lowers her eyes and says, you see, we don't have another hospital in Novosibirsk. And I'm like, well, where are all these rich people who drive Maybachs? Where do they get treated? Mom says, right here. So it's just one hospital that deals with this. Like it's grim, and there's nothing you can do. And I was all bravado, like I'm going to send Grandpa to Israel, because there was this brand name. Like Israel has great medicine. I calculated on the calculator and realized that I can't afford it, even if my salary triples. To send Grandpa for 3 to 6 months on a program to Israel, I just don't have enough money. At that moment, I kind of had an epiphany. I recalculated my stocks and how much they would be worth at their peak. And I realized what real-life management and true security are. So, if I'm interested not only in myself, and I include my family and possibly some dear people in my security, then, overall, if I really want to influence something in life and not just suffer when a fatal event happens, then I need no less than X amount of money. And X turned out to be huge.
How much?
Listen, well, look, first of all, how much is it in millions of dollars?
Millions?
Even millions.
Like just in case of...
In case of some crap, yeah. The main
driver of founders is trauma. Most often childhood. Oh, really? Most often childhood. And then there are different traumas. Some have attachment issues. Some have anxiety. It's different for everyone. But a normal person will never become an entrepreneur. They don't need it at all. Very interesting. They'll go work at Sainsbury's, Magnet, Piotrushka. And if you look, 90% of people in the world don't need entrepreneurship at all. Wow, listen, this is a revelation for me. Interesting. I never thought, it's very logical what you're saying, like the driver, especially for this founder who wants to work more, after $10 million, it will be an unresolved trauma. So like, don't go to a psychologist, right? He will solve all your issues. You'll relax. This is, by the way, about the moments I thought about when leaving the psychologist again. Because it calms you down a bit, because I also have my traumas that I've been through that always, drive me. You know, the most classic example of a company that didn't take off is Segway. At one point, people thought, investors in Silicon Valley thought, that everyone would be riding Segways. And even in movies, they showed everyone riding them awesomely. Yeah.
It would have been cool if it was like that.
Yes, it's still good now. It's just that the market turned out to be much smaller than predicted. A huge number of venture investors invested in it. Some made money, some lost money, because the company was sold. It was sold for not very much, but still. Here's a classic example of when a founder tried, by the way, a well-known fact, only one person died on a Segway, and it was the founder of Segway.
Yes. On an off-road, I think, right?
On one hand, it's a creepy story. On the other hand, it's a question of the uniqueness of founders. He was constantly trying to find the limit of where you could go on a Segway. Because the Segway is built in such a way that a person almost can't fall off it. He climbed a mountain, and a rock just fell, and he rolled down with the rock along with the Segway. And he hit his head. After that, by the way, people started riding them with helmets. If we return to venture capital and throw out some red flag niches and, on the contrary, green niches, where would you start? Green meaning all good or all bad? Yes, all good, right, I guess, isn't it? Well, look, 5 years ago in fintech, the multipliers that are now in AI were normal. And now those multipliers are no longer there. Can you be more specific, for example? Well, I mean, like, Tinkoff was trading at a revenue multiplier of 30, being a public company 5 to 7 years ago. Accordingly, in the private market, the multipliers were the same 100. I know several fintech companies that were valued at 100 to 200 times revenue in 2021. Are these big companies today? Some of them grew, some died. Pretty standard for this market. But the problem they faced is the following. In 2021, they had, let's say, $500,000 in annual revenue and a multiplier of 100. That means they were worth $5 billion. This is endless madness. So now 5 years have passed. The multiplier now is good if it's 5. So, to be worth $5 billion, they need to earn $100 million. Not everyone can go from $500,000 to $100 million in 5 years. My approach is like this. No, how is it? There are no bad niches? Oh, really? You think there are really no bad niches? There are no bad niches. You can build a business in any niche. Can you build $1 billion business? That's the question. And that depends on whether the market is big, small, and so on. Good execution, whether people work well or poorly. But fundamentally, I don't know, you can make pizza and become a company worth billions. A good example is Domino's Pizza, a wonderful company. You can be a toxic company. Uber is another example. Uber is worth more than tens of billions of dollars. In different niches, you can build a big business if there is a sufficient market volume, or it's being created now. 30 to 40,000 startups are created each year. Oh, interesting, really? Is that like a real statistic? Yes, it's a real statistic. Worldwide, 30 to 40,000 startups. And in terms of unicorns, in 21 to 22, there were 100 to 150. Last year, I think, less than 100. So 30 to 40,000 founders, with 2 to 5 founders per startup, turn into 50 to 70 companies worth more than $1 billion. Over 10 to 15 years? Yes. Accordingly, there are 5 companies worth more than $100 billion, I think. OpenAI, Anthropic, SpaceX, yes, something like that. And so on. So there are very few of them. Why am I saying this? Because for a venture fund, it's normal for some companies to fail. But the media mostly talks about the successes and very little about the number of failures. And the founders who couldn't make it, they then have to find jobs and so on. That's also a big painful story. For example, from your experience with founders who didn't succeed, what was the most common reason? Reason for failure? Yes. Look, from stage to stage, most often at the very early stage, it's like tansaredi. It's like the team got together but didn't agree on who does what. So that's such a common reason? It's more than 50 to 60% of cases when co-founders argue at the pre-seed stage. Wow. Interesting. It's like a clash of egos. Still, roughly, can you say out of 100% how many people don't succeed because they just gave up early? Listen, I can't tell you. Look, some people just turn into a normal small and medium business, for example. So they just keep earning their 1, 2, 3, 4 million in revenue, or 500,000 or 200,000. But they grow. Is that the majority? That's the majority, yes. 80%? Yes, yes, yes. Most likely it's, well, I mean, from 60 to 80%, it's, in venture, technically these people are called zombies. Although in reality, it's an absolutely normal, living business. They can't return a significant part of the capital invested in them. Their value is lower than the money invested. Accordingly, no one really pays attention to them. There's a section called Pitch from a Subscriber. I'd really like to hear yours, Anton Gladkov. Automatic schedule for a child. They upload information about behavior, the existing schedule, and in general, the model automatically gives them a schedule. That's the idea. Start.
I think ChatGPT will offer this out of the box in 15 minutes. I don't think this can grow into a billion-dollar story, to be honest.
No, let's put it this way. It all depends, as I said. There are no bad projects, there's bad execution. There's execution, yes. It's quite possible that he can build a product that goes viral. And many parents have problems with scheduling, with calendars. It's a known problem. Right now, the penetration of ChatGPT and similar products is still very low. In our circle, everyone talks about Claude, ChatGPT, Anthropic, and so on. But in reality, if you look at the world, it's good if 3 to 4% of the population have heard about it and use it somehow. A huge number of people continue to go to the App Store and write schedules for children. If a person can build good unit economics and a good product, it can take off. Would I invest in such a project? Probably not. But that's again due to my mandate, my mindset.
By the way, speaking of the mandate, there's a really good example, FLO, a period tracker. My girlfriend used it. And then she told me later she even paid for it for a while. Well, we also had a friend working there. Maybe that influenced it somehow. But then she tells me, listen, you know what I realized? That actually this app doesn't offer anything more than a regular calendar built into any phone.
A regular calendar? Yeah.
Absolutely nothing. She says, but they sold it to me in such a way that for a while, I felt like I was actually getting something for myself. And in the end, Flow, they managed to build such a product completely pointless, to be honest. There you go.
By the way, I had a question somewhere above. How much does a technological solution align with the company's valuation? Because DocuSign, for example, is a company where you sign documents just like that. It's still valued at $90 billion. And what was said about FLO, yeah, it's just a regular calendar. And I think you could name 100 more like that.
That's execution. They did the impossible. That's why they're wealthy people whose company is valued at $9 billion. They just went and did the impossible.
Thank you, friends.
It was very interesting.
Really, thank you. It's almost a shame to end.